The rich ruleth over the poor, and the borrower is servant to the lender. Proverbs chapter 22 and verse 7. Now, you and I live in economies where borrowing is the order of the day. I mean, from the government all the way down to individuals, they are telling people to borrow. And they will always say, you need to borrow so that your credit will be good and all of that. Credit cards, loans, car finance, buy now, pay later, Klarna, overdraft, all kinds of borrowing everywhere. And maybe you are a little bit overwhelmed, actually. You're not sure, like, one person says this, you have to borrow to do this. One person says it's fine, it's normal. But obviously, as a believer, we believe in what the Bible says. And it does say that the borrower is subject to the lender. But I also recognize that we live in the real world and we live in economies where we need to be able to make use of what is available to us. So let's talk a little bit about these different types of borrowing, the pros, the cons, and also some lessons that we can learn about borrowing. So let's talk about credit cards. Number one, credit cards are probably the most common form of borrowing. Most banks will give it to you as part of your bank account. And you know what it is. You swipe, put your PIN, whatever, pay according to the limit. They can give you a £250 limit, £50 limit. They can give you a £2,000 limit. They can even give you all the way up to £25,000 limit on a credit card. But a credit card is basically short-term borrowing. Emphasis on the word short-term, because some people be using their credit cards as if it's a loan facility. If you try to use your credit card to pay for something massive and you plan to pay over 1 year, 2 year, 3 year, you will land yourself in hot soup, or should I say trouble for our more British viewers. If you are using a credit card, the whole point of it is that it's for short-term borrowing. And so what you find is that the interest rate is very high. So the idea is that you use it and you pay it off quickly. Then you have loans. Loans, I'm sure we all know what a loan is, but a loan can vary literally from 12 months short-term loan to a 6-year loan. Some people even have longer loans. But because the amount tends to be higher and you tend to be lending over a longer period of time, the interest rate tends to be lower. And so you should be using loans for things like cars, bigger assets, maybe a business investment, something that you're going to hopefully get returns back over time. Loans are not to be used, for example, to go and buy shoes or trainers, right? But you can use your credit card to buy shoes and trainers. Not that I'm recommending you do that, but you get what I'm trying to say. Short-term versus long-term. Of course, you have specific finance that is for specific items, so like car finance, you have mobile phone finance. They're all forms of loans, but they are specifically attached to a gadget or to an asset. Anyways, specifically attached to an item. And so you have specific loans, but of course, even with cars, there are other things like leases. So with a lease, it means that you are not, whereas with a loan, you are borrowing a certain amount of money, and as you are paying down, the amount is reducing, and at the end, the idea is that you own the car or whatever it is you might have used the loan to pay. With leasing, for example, on a car, you are actually borrowing the car. You are paying monthly to have access to the car, and at the end, you are unlikely to have the ownership of that car. Similarly with hire purchase. Hire purchase is a combination whereby you are hiring, leasing for a term, and at the end of that term, which may be like 3 years, 4 years, 5 years, whatever you decide, there may be a balloon payment, a large one-off payment, which then says that you now own the car. Hire purchase tends to have a lower monthly payment compared with a car finance loan, for example, or a loan. Why? Because, like I said, with the loan, you are paying down whatever it is you have borrowed. With a lease or with a hire, you are literally just borrowing it. And so therefore it's cheaper. And then we have the wonderful buy now, pay later. I know DFS used to be the #1 store that really, really spread that into the market, right? buy a sofa today and pay in 4 years' time. Now, I know that sounds great, and I know you wanted a sofa today, and so you've signed on the dotted line. But in reality, is a sofa an asset? And if you don't know what an asset is, you need to listen to my last video. But is a sofa an asset? And by the way, in 4 years' time, when you begin to pay for that sofa, do you think your sofa will have the same value as when you signed up a couple of years ago? Probably not. What am I trying to say? I don't think it's a good idea. Don't get me wrong. I know some people, that is the only way that they can afford to get certain items. And obviously a sofa is just one thing. You can buy now, pay later on your fridge. You can buy now, pay later on many household appliances. But if you do decide to go down that route, I want to encourage you to actually think of how you can pay it off sooner. Such buy now, pay later schemes, I wouldn't necessarily say they have high interest because they are over a longer period of time, but in my opinion, they don't necessarily have the best addition to your life because you are buying, or most times you tend to be buying liabilities. And so you find that you're paying for something that has really decreased in value. It's no longer worth the amount. And so if anything, I would say if you can rustle some money together and buy a second-hand sofa, or rustle some money together and buy a cheaper fridge or whatever it is, that might actually do you better than buy now, pay later on household items. Klarna, similarly to buy now, pay later, this is you using the online platforms to be able to do your online shopping. And Klarna will tend to say sometimes, pay later, or like pay in 3 installments or pay in 4 installments. To be fair, paying in 3 or paying in 4 is not as bad. It's more like a credit card. But the truth is, I'm not aware that Klarna adds to your credit score. If anything, it takes away from it. The credit cards, the loans, the car finance, and even the buy now, pay later that I've just mentioned, not just car finance, but any kind of finance on your mobile phone. When you do take out these forms of lending in the Western society, your UK, America, Canada, etc., these things do actually positively add to your credit score. But you see that Klarna, pay in 3, pay in whatever, that's not adding. And worst of all is the overdraft. Now, this overdraft, what should I say? Your overdraft is normally an extra lending facility that is attached to your main bank account. So let's say you have a bank account, you get paid your salary every year, or every month rather, £2,000 every month. Your bank can say, actually, we will give you an overdraft of £500, for example. And so when your salary goes into your bank account, your £2,000, if you didn't have an overdraft, you would see balance £2,000, money available £2,000. When you have an overdraft, you might see balance £2,000, but it will say money available £2,500 if your overdraft is £500. And what it basically means is that it allows you to go into minus. So you can spend your whole £2,000 and then some. Now, the thing about the overdraft is that it is so easy to go into if you are not disciplined. And worst of all, it doesn't actually positively add to your credit score. Now, don't get me wrong, it's good for things like, oh, I forgot that I had a direct debit and for whatever reason it's gone into minus, even though if you've been following properly from the beginning of Business, Faith and Finance, you know how to budget, you know how to plan, so you don't need to go into overdraft. But just in case something happened, you needed to go into, there was a direct debit, a bill that needed to be paid. Your overdraft is good for that kind of thing. But for long-term borrowing, absolute no. First of all, with an overdraft, you will have a overdraft usage fee, which is normally £12. Now, £12 on its own it's okay, right? If, as a one-off fee for using something, maybe not that bad. But should you be paying £12 usage fee just for borrowing £100, for example? That's 12%, the equivalent of 12% interest. The other thing about the overdraft is that you are not just charged for the usage fee. It's not only very easy to use, it's not only not going to add to your credit score, but also with the overdraft, you are charged interest daily. Now, here's the catch. The daily interest, they may say something like 0.1% interest, 0.2% interest, which sounds so low. But if you calculate it, even if that interest works out to be £1 a day, in a month, potentially for using your overdraft facility, let's say you're somebody who has I don't know whether to call it a privilege or blessing or maybe curse or not so good thing of having an overdraft of £2,000 or £3,000, you might find that that £2,000 overdraft or £1,000 overdraft is costing you £30 a month. Or if the interest is like 1.5 or £3 per day, it soon adds up. And so the costs of using an overdraft facility are so high. This is one of the least recommended forms of borrowing I would ever recommend to anybody. Now, there are also other types of borrowing that are not maybe as common, but just to be aware, things like bridging finance. Bridging finance tends to be used when you're talking about property and you're trying to just bridge, as the name would imply, a short-term gap. Maybe you want to quickly do a refurbishment. You want to use the money within a, 6-month window maximum, but ideally probably 6 weeks window, 3 months window, but maximum 6 months. And you want to be able to just tide yourself over whilst you are waiting for longer term borrowing, like a mortgage, which is also another term of borrowing. Maybe I will do an episode specifically on property because I know that's a big one that many people like. Anyways, bridging finance helps you to cover the gaps. And as it would imply, because it's a bridge, it's short term. It should be used for a short term, and therefore it also has very, very high interest. And then you have payday loans. Again, just like the overdraft, really one of my least recommended. Payday loans are basically you saying, I need a couple £100, maybe even up to £1,000 or so, just to tide me over until my next payday. And when my next payday comes, I'm going to pay off the loan. Now, the challenge is with the payday loans is that if your salary was not enough last month and you had to borrow this month, it's very likely that when your salary comes in next month, it's still not going to be enough. So how are you going to be able to pay the loan that you borrowed and then still pay for what you need to pay for in the new month without borrowing? Unfortunately, the thing about the payday loans is that you end up in a revolving circle that you really can't get out of. Similarly to overdrafts, many people go into minus, their salary comes in, they go up into plus, and then they go back down again because they're living in their overdraft. The thing about the payday loan is that you end up living on the loan. And so these are different types of borrowing, different types of lending. Maybe you've heard some of these before, you weren't too sure about what they are. I hope that that quick breakdown has just explained it for you. But what I really wanted to emphasize there is the ones that do actually help your credit and the ones that don't. And by the way, even when we say that, okay, using a credit card or taking out a mobile phone on finance or whatever might help your credit, the truth is that this must be done with discipline, capital D, for discipline. If you are the kind of person that's going to be swiping and buying things on your credit card that you don't need, can't afford, it's not for you. It's for people who have been able to exercise and discipline themselves when it comes to financial management. If not, leave it alone, in my opinion.